Our next job for the homework is to construct the statement of cash flows. In the assignment, I only ask you to plug in all the formulas in this financial statement. However, you need to know more than that. For example, you should know that in a statement of cash flows, there are three categories. There are operating activities, there are investing activities, and there is also a group called financing activities. And you should know that which item belong to which category. And that's a very challenging part. So before I move down to the Excel exercise, I just want to introduce you the basic terms for the financial statements. And that lead me to PowerPoint file for Chapter 2. And Chapter 2, as I said, is about financial statements, cash flow, and taxes. And here are the topics that are going to be covered. So let me first introduce the income statement. So income statement summarizes the firm's revenue and expenses over a given period of time. Like you have an annual report, you may also have a quarterly report. And in the income statement, it tells you how much in total that the firm made or spent in this period. And the balance sheet is a little bit different because it provides a snapshot of a firm's financial position at one point in time. Again, the balance sheet could come annually or quarterly. So at the end of each year, there is a balance sheet. And the numbers in that balance sheet only explains how much assets the firm has at that particular time point, or how much liabilities or equity the firm has at that one specific time. But it does not tell how much the total assets change or accumulated during the entire year. And the statement of cash flows, which I really want to emphasize, reports the impact of a firm's activities on cash flows over a given period of time. I can tell you that the statement of cash flows is actually generated from the items in the balance sheet. If some item change, like inventories increases, then that would have some cash effect. If you buy more inventory, that would require you to spend some money, right? So your cash should go down. And likewise, if you have borrowed more money, you increase your long-term debt, then you should have more cash in your pocket because you just borrowed the money. And that is the cash flow effect as well. And here I'm going to skip the following two slides. One is about income statement and another is about balance sheet because I have already addressed all the details in our previous exercise on the spreadsheet from your textbook. What I really want to emphasize here is on the statement of cash flows. So it reports the impact of firm's financial activities, operating activities, and investing activities. So these three categories, you must remember them. And you should also remember that if assets increase, like your inventory increase, your cash would be reduced, would decrease. That's because you spent money to buy that asset, so that assets increase. So cash should reduce accordingly. And on the other hand side, if equity or liability increases, it's like you raise more money from equity investors or debt investors, then your cash should increase because you just borrowed, raised more money, and that money is in your pocket now. So the effect here is a decrease, and the effect here is increase. Just remember that. It's completely opposite. And in your basic accounting 101, you know that total assets equals to total equity plus total liabilities. And also we know that the change of total assets from the last year to this year, from 2015 to 2016, from 2020 to 2021, the change of total assets equals to the change of equities and the liabilities over the same period. And if you further break down the total assets into cash and non-cash assets like account receivable, equipment, machinery, and land, then you can have the change of total assets as a change of a cash and a change of non-cash assets. And also you can further break it down, the change of equity and liabilities separately. And then based on this equation, you're gonna move the change of non-cash assets to the right-hand side of the equation and on the left-hand side, you only retain the change of cash. So this is a algebra play, but you should clearly see that at the end, it's a change of a cash equal to change of equity, which is a positive, plus change of liability, which is positive, minus change of non-cash assets. So if a change of equity is a positive, you get more cash. If change of a liability is a positive, if that increase, you get more cash as well. However, if you have more non-cash assets, then you should end up with less cash, and that's the rule of statement of cash flows. And it also makes intuitive sense. If you pay off your debt, then you have less liabilities. You also have less cash because you spend that cash to pay the bill. And if you buy more machines, then the non-cash assets would increase. Then your cash would reduce by the same amount. All right. As I said, the statement of cash flows are based on the items from the balance sheet. However, some of the items on the balance sheet could be further broken down, and we're gonna replace all these changes of items using the items from the income statement. So what do I mean by that? If you look at the accumulated depreciation, which belongs to the balance sheet, and we want to know what the change of it from the last year to this year, and the change of it happens to be the depreciation expenses from the income statement. You see, accumulated depreciation is from the balance sheet, whereas depreciation expense is from the income statement. And likewise, if you check the retained earnings, that's from the balance sheet, and the change of retained earnings, as I stressed earlier in the previous exercise, equals to the net income this year minus dividend this year, and they both come from the income statement. After the replacements, then I will combine net income and depreciation altogether to recoup the non-cash cost on the operating side. So what do I mean by that? You see, net income is after depreciation is deducted, and depreciation is by all means a non-cash item. So just to put this way, you just bought a car for $20,000 and you drive it for 5 years, and then your car is worth $10,000, half its original value. Then in total, you have 10,000 accumulated depreciation for 5 years. So each year, your annual depreciation is 2,000, from 20,000 to 10,000. So you have 5 years, and each year got you $2,000 depreciation. But you don't spend $2,000 cash for that depreciation. You don't see money being out of your pocket. You just see the value of your car got reduced, and that's it. There's no cash effect from depreciation. When we construct the statement of cash flows, you should know that depreciation has to be taken care of because it's a non-cash, and the net income is not 100% cash. So if you check your income statement in the spreadsheet, you have a net sales, which is a cash. You have a cost of goods sold, which is a cash. However, this depreciation is about worn out of your equipment is a non-cash, and all the others are cash items. So because you deduct this non-cash item at the beginning, then that makes your net income not purely cash term because it's after depreciation. So how could you resolve that? You could just add back depreciation you first subtracted to the net income. And this is what I mean by recoup the non-cash cost on the operating side. All right, and here are some true or false questions I want you guys to think about. So first, depreciation expense is not a cash term and therefore should not be on the statement of cash flows. This entire statement is false. However, the first half is correct. Indeed, depreciation is not a cash term, but it should appear on the statement of cash flows because if you combine net income and depreciation together, then you would have a cash term. So let me just put it in Excel to show you better. So you will see a sales minus costs minus depreciation minus the interest minus taxes, and then you will have a net income. Okay, and you know that sales is a cash, cost is a cash, depreciation is not cash, interest is cash, taxes is a cash. So we're at depreciation to net income, then the net income plus depreciation will be equal to sales minus costs minus interest minus taxes. And all the four items, 1, 2, 3, 4 items on the right-hand side of the equation are pure cash terms. So that makes net income plus depreciation a pure cash term as well. So these two together will appear on the statement of cash flows. The second question, true or false? Interest and taxes are cash paid by the company. So this first half of statement is true. It is a cash term. Therefore, they should be on the statement of cash flows. The second half of the statement is incorrect because the interest and the taxes are already deducted, and you have net income which has already incorporated sales, cost, interest, and the taxes. So if you put a net income in your statement of cash flows, you do not need to put an interest and taxes again in the statement of cash flows. All right, let's get back to the assignment 1 and finish the statement of cash flows. So your requirement again is to plug in the formulas behind the sales. So the first one is that income is definitely coming from the income statement. And as I said, it is so tiring to move back and forth, go to the upper statement and borrow the number from there. It's just too much. So what I taught you is to create a new window, and then after you have two windows, you click view again, arrange them vertically so you can see both statements at the same time. So I want you guys to show the statement of cash flows on the left hand side, and then the balance sheet on the right hand side. Okay, so the first one is net income before preferred dividends, and that actually comes from the income statement. So on the right reference window, just to scroll down to the income statement, and right here you would borrow this number 228. You would borrow this number 228. So make it equal to that number. And then the next thing you're going to do is to add back depreciation. As I explained, that depreciation, although it's a non-cash item, but it has to be on the statement of cash flows together with net income. And depreciation is right here, the 200. And then you will need to take a look at the working capital adjustment. All these items, accounts receivable, inventories, accounts payable, accruals, are all belonging to the current assets or current liabilities. And working capital basically is current assets minus current liabilities. So first of all, the increase in account receivable. So we move up to the balance sheet and we look at the change of account receivable. You see the number changed from 380 to 500. It actually increased by 120. You see 500 minus 380 is 120. However, the number input here is negative. It is because this accounts receivable belong to assets. When assets increase, then the cash effect should be negative. Likewise, inventories belong to assets. So when inventory increased by 180, if you check the balance sheets right here, from 820 to 1000, that's a 180 increase, but the cash effect should be negative. So let me just plug in the formulas. So I will use a negative 1000 inventory minus 820 inventory, and then hit enter. And for the account receivable, the change of that is a negative the 500 new account receivable minus the 380 old account receivable. And for accounts payable and accruals, they belong to liability, and when liability increase, that's gonna make your cash more. So for accounts payable, the change of it would be just the new minus old. All right, and the same for increase in accrual, new minus old. There's no negative sign for the difference. And then we move down to the net cash provided by operating activities. So what you do here is just to add them up, all the numbers here, then hit enter, 158. And then we move down for the investing activities. So the investing activities are not about operations. The investing activities is about long-term investment in the fixed assets and also the short-term investments in the securities. So you have two items here. One is a change of fixed assets, and that belongs to the assets part. So the increase of that would lead to negative cash effect. To calculate this negative 500 result and plug in the right formula is actually pretty challenging. This is cash used to acquire fixed assets, or the change of fixed assets is not directly provided in the balance sheet. So what you see on the balance sheet is net plant equipment, and this is a net fixed assets, which is the fixed assets by itself minus the accumulated depreciation. So we have to do a little algebra here. So let me just first put this as the net fixed assets, and that equals to the fixed assets, which means the plant equipment, minus accumulated depreciation. So after years and years of depreciation, some value got to be reduced. And then on the statement of cash flows, what we care about is the change of the items. So first, the change of fixed assets would net fixed assets equals to the change of fixed assets minus the change of accumulated depreciation. And I have already covered this. The change of accumulated depreciation is actually the depreciation expense in the current year. And in the statement of cash flows, the cash used to acquire fixed assets is actually the change of a fixed assets in the equation. So I will do a little bit of algebra here. Change of a fixed assets, it equals to the change of a net fixed assets plus the change of a accumulated depreciation, which is a depreciation itself. Okay, so just remember that. And to put the right formula here, the change of fixed assets equals to the change of a net fixed assets, and this is 2,000 minus 1,700. Okay, and then I will need to add the depreciation, which is the 2,200. It's in the income statement. It's right here. All right, and the entire thing has to put a negative sign, because once the fixed assets increase, then the cash would be reduced. Whew. This is a very challenging work, as I have to do a little bit of algebra here in order to figure it out. All right, and then the change of short-term investments, I move back again to the balance sheet, and I will see my short-term investment was $40 a year ago. Now it's reduced to 0. So I have some investment, and now I have a cashed out with no investment. So basically, I sell my investments and I get the cash received. And once again, since my investment reduced, so I will use this 0 minus 40. So this outcome will give me negative 40. But I know that the change of assets should have a negative effect on cash. Okay, and then to get the total here, then I have this net cash for the category. And the next category is about financing activities, and these activities are related to the raising capital activity in the financial market and also paying off the investors. So the company have several ways to gather capital. They either issue notes payable, as you can see right here. The company have some outstanding short-term debt. It increased from 130 to 280. And also the company issues long-term bonds from it increased from 1,000 to 1,200, so that's an increase of $200. And also the company pays the dividends to preferred and common equity holders. So the Excel formulas here are pretty straightforward. I will just use the new minus the old because it's a liability, then it has the positive effect on cash. New minus old. And then for the payments of a dividend, I will scroll it down all the way to income statement, and I know the whole thing has to be negative because dividend payments are negative cash flows to the firm, and the number here include preferred dividend and common dividend. Okay, and then get the whole summation of it. Oops. Summation, and get the summation of the three numbers. Okay, and you may wonder, hey, here I got a short-term investments and here I have a notes payable. Are they the same thing? Actually not. Notes payable as well as bonds are securities issued by the company to borrow money from investors, whereas the short-term investments in the investing activity is about the firm using its own money to buy securities from other companies. The firm in this scenario is actually an investor, not a borrower. So this is not a financing activity, but an investing activity. Having get all the three subtotals, I'm going to take the grand total, just add the three numbers together, and then I have my net change of cash, which is a 10. So from the last year to this year, my overall cash balance got reduced by $10. And that $10 deduction comes from some earnings from my operating activities and some big investment, big expenditure here, and also some money raised from the financial market. Okay, so what was the cash balance at the beginning of the year? It was the same. It was the same balance at the end of the last year. So I'm going to get to the balance sheet on the reference cell. It's $60. Okay, and then the cash and the securities at the end of the year. So after $10 got spent, it will be $50. Okay, so this is the end of the statement of cash flows. To really complete these financial statements, not only we need to finish off the rest of net cash flows, but also I want you to pay a close look at this cell, which is the cash equivalents on the balance sheet. The number here is a 50, which is a given number, and we're gonna replace this number with the cell we just calculated right here. Okay, so everything is connected. So what do I mean by that? If we take a look, if we just change some of the item, did some adjustment, for example, the inventory in the new year, instead of 1,000, I'm going to make it a million, an extremely large number to show my point. Then what you see is I have a big change in the cash and equivalents, and my entire balance sheet is not violated. You see the total assets still the same number and the total liability is the same number. However, when the inventory changed by that much, if I scroll down and check my statement of cash flows, you will see the change in inventory, and that's gonna cause my cash to reduce by that much. and then my net change of cash is going to be a quite large negative number. And another one is, let me just recoup that. And if I do another change, let's say if I have more sales in the new year, instead of 5,000, I'm going to make it 5 million. And what you see here is there's a chain of reactions that leads to a quite large net income. And then I just check my statement of cash flows. You see when net income increased by that much, so is my net change of cash. Cash level in the new year would be quite large. If I check my balance sheet, then you will see that the total assets got changed to this much, and also the total liabilities and equity changed to that much, all coming from the change of retained earnings. As I said, retained earnings includes the net income minus dividends. So when net income changed due to a inflated 5 million sale, then the retained earning also changed accordingly. So my point here is my total assets is always equal to the total liabilities and equity. And this cannot be achieved unless I change the formula for the cash here. Okay, now let me recoup the setting. Okay, so the net sales got to change back to 5,000. The last part of the financial statements, or the first question of your assignment, is to calculate the net cash flow, which is super easy. So you have a net income just connected to the income statement. It's right here, 220, and the next year is the 260. Okay, drag it. And the depreciation here, get back to the income statement, is a 200. In the next year, it is, in the previous year, it is 170. And then you just sum them up. Nice and easy. So once again, net income is not 100% pure cash because that is after depreciation. And then after you add back depreciation to it, then you have a solid cash flow term.